All right, everybody, here we go with the notes for Chapter 5, talking about financial management, getting into the money aspect of things and thinking about the business, well, from a business standpoint. In business, success is measured primarily by the bottom line, the amount of net profit or loss that remains after one deducts expenses from revenues. So you have to keep in mind when you're in business, you're trying to earn money. And the more money you earn, the more quote unquote successful you become, at least from a financial standpoint. While many tasks and responsibilities are delegated, the manager remains directly responsible for financial matters. So the way that the success of the business from a financial standpoint comes about, the direct responsibility of that is on the manager, because that person is the one that is making the decisions that has caused the profit or loss that a company is realizing. So what is financial management? Well, it involves three different things. First off, systematic planning mainly concerns developing budgets based on revenue history and expense projections. One also plans for new personnel positions and establishes timelines for the upgrading and replacement of expensive items, such things like capital equipment, vehicles, technology, all those sorts of things. So you are trying your best to forecast what some of the expenses are going to be that you're going to incur, both short-term and long-term, and keeping in mind what you believe your projected revenue is going to be over that period of time, that you can cover those expenses and also still maintain a profit. The second aspect of financial management we'll look at is monitoring. Monitoring takes place through managerial review of financial statements and other reports that measure the efficiency of an organization. So over the course of, say, a year, you're going to be looking at how well you're doing against what you have budgeted. Are you bringing in the projected income that you thought you would? How are your expenses doing? Are they staying in line with the budget? Are they getting out of control? Are there some things that need to be changed in order to try to continue to stay on pace or to reach your goals? Thirdly, control. This can take many forms, from authorizing purchases to establishing internal policies and procedures. Control of fiscal policy helps eliminate ambiguity in an organization's financial matters. So you want to keep a watch on things, and based on what the financial reports are telling you, make decisions that are going to make sense in light of your current financial situation. Okay, so now that we know that we are making plans, that we are monitoring things as they happen, and we are taking control as is necessary, let's now talk about what it means to meet financial goals. Setting financial goals is a complicated process affected by many factors beyond the control of managers and owners. So you have to consider a lot of different things that are coming your way. That also includes things that are not necessarily within your ability to make a change and to fix things. So there are things that we have to consider that are outside forces. Things like the state of the economy, the national economy, the local economy, what's happening in your community, the ways that those sorts of things are going to impact not just your own ability to make purchases, but the ability of those that patronize you are going to be able to make purchases. It's also going to affect the way that your employees are able to have enough of a living in terms of their financial situation to be able to do the things that they need to do. And that's going to affect the company in certain ways. Also consider technological change. What sort of things are creating advancements that may make the world of business faster, easier, convenient, sometimes more expensive, whether it's more expensive in terms of the material cost, more expensive in terms of labor cost, more expensive in terms of services that you may need to acquire, those sorts of things. Regulatory issues. So we're talking about taxes. We're talking about laws that may require that you uphold things to a certain standard. Those sort of things may cost money in terms to implement and may cost money in terms to regulate, so that you make sure you're in compliance with those laws. And then audience tastes and preferences. We're keeping in mind that we're out there communicating a message to an audience. And if the audience decides that they need something in a different way or desire a change, then that may be on us to provide that in one way or another. And that is going to be in some fashion an economic decision. One can establish financial goals in many different ways, ranging from revenue projections to cost-saving methods. So you have many different ways that you can take a look at the bottom line of your organization. If you're trying to increase your sales, or if you're trying to maybe increase inventory in some way, maybe there's an opportunity to have more commercial avails, or you have different types of programming that would allow for more sponsorship opportunities. So you increase the inventory in that way, or just increase costs to meet up with the cost of inflation, or in an attempt to increase revenues, be a little more competitive in certain ways. You may have to decrease some of the things that you're charging. So all those sort of things are coming into play, as well as taking a look at what you're actually spending in terms of personnel, in terms of equipment, in terms of maintenance and subscriptions and all those sorts of things, and maybe deciding that you need to cut spending in one area or several areas. Implementing financial growth, the personnel that are involved. Well, in small firms, you're looking at a bookkeeper or a traffic manager. Keep in mind, in the media industry, when we talk about a traffic manager, we're talking about someone that takes care of scheduling commercial contracts and dealing with clients in that sort of way, making sure that commercials and sponsorships are being handled in the proper way at the proper times. And many times that person is also going to be involved in the billing of those clients once those contracts have been fulfilled. In a medium-sized firm, you might have an accounting or business department where different people are taking on different aspects of watching some of those things that might normally be handled by just one person in a smaller firm. And then larger firms also have a controller or a comptroller. This is basically a mid-level manager who supervises all accounting functions and prepares reports and other materials for upper management. And you can imagine, if it's a larger corporation where there's many media entities that are involved, that there are a lot of things to aggregate together and to kind of watch in terms of how it's affecting the big picture of the company as a whole. Traditional electronic media enterprises are capital intensive, consisting of a number of expensive resources. To maintain control over the cost and flow of revenue and expenses, businesses use financial systems to keep track of all the transactions. Even if you're just using pen and paper, traditional accounting methods, that is a system in order to make sure all those things are going into place. Even if the system is as simple as a checkbook, it's a system. It's some sort of accountability. That's why we call it accounting, to make sure that income and outgo is being properly tracked and all those sorts of things. Most companies these days are going to use some sort of a software solution to help them to do that. If for no other reason that paper can take up a lot of real estate. And not to mention the fact that paper also increases opportunity for errors, especially if there are a lot of transactions to consider. So you may have purchasing and personnel operations that help to track some of the things that are happening. You may have data management software that's going to track certain logistics of different things that are happening in several departments throughout the company. Revenue and expense tracking, your traditional accounting software sort of things like QuickBooks or some other sort of tracking system. And then commercial inventory and billing. Again, we call this traffic in radio and television. And that software will also include the ability to look at how much we're charging for advertising with different clients and is able to help forecast what projected revenues are going to be for the station as a whole and even for salespeople in particular that are making those sales. So at this point, let's take a break. When we come back in part B, we're going to continue on and take a deeper dive into some of the things from an accounting standpoint that we want to at least be familiar with and have an understanding of what those things mean as it relates to how we make decisions as managers in media.